Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're looking at 3 blue chip tech stocks to consider buying with the market at new records to start November. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so the S&P 500, the NASDAQ, and the Dow all hit records during the last week of October. The resilient and always forward-looking market was able to shrug off Q3 GDP growth concerns in that slowdown in favor of the positives. All 3 indices then also touched new highs Monday morning to start November trading. So all this positivity is on the back of improving earnings picture that includes everyone from the tech giants to companies like Ford. The S&P 500 margin outlook also remains strong for 2022 and beyond, despite rising prices and supply chain setbacks. Plus, the consumer-driven U.S. economy flashed comeback signs in the first month of the fourth quarter with strong hotel occupancy data and restaurant dining data as well, and consumer confidence increased in October after 3 months of declines. So that bullish outlook is further supported by the low interest rates that will continue to favor stocks for the foreseeable future. With that said, some big names in the broader market could face a near-term pullback after the strong run in October sent stocks from some oversold RSI levels, oversold technical levels, all the way back to the cusp of overbought technical territory. So that 1 month surge to new highs could then see a bit of a pullback in the near term, but that doesn't mean long-term investors shouldn't consider adding strong stocks, especially since timing the market is so difficult, as the last couple months alone have shown you, as traders are calling for a much larger pullback and all of a sudden you're back at new highs. So trying to stay exposed is a good thing, especially if you're considering long-term investing and buying strong, stable stocks. So we're going to look at 3 big blue chip tech names to consider buying. And the first one we're going to take a look at is a company that reported its results last week, and that is Microsoft, which trades under the ticker MSFT. So the stock topped our Q1 FY 2022 earnings and revenue estimates last week, with revenue up 22% to over $45 billion and its adjusted earnings up 25%. So in terms of its individual business units, its productivity and business processes, revenue was up 22%, with commercial office products and cloud services up about 18%, driven by its Office 365 business. Meanwhile, its intelligent cloud revenue surged 31% to contribute the most to its top line, contributing $17 billion. Then its personal computing segment climbed about 12%. We should also note that along with its growing cloud business and its other successful segments, its search advertising revenue is continuing to climb, with that up about 40% last quarter as more and more ad revenue shifts digital. The company is getting a bigger and bigger portion of that digital advertising dollars, and especially with Facebook and Google coming under more pressure, maybe you could see more advertising dollars go towards Microsoft's way. So the expanding portfolio and its growing cloud computing business has helped the company that went public all the way back in the 1980s rip off 4 straight years of solid double-digit revenue growth, with it posting 18% sales growth last year. So looking ahead, our Zacks estimates call for its current year, so 2022 revenue, to climb another 16% and then climb another 13% above that to reach $220 billion next year. So both of these outlooks have also improved since its recent report, and they would extend the firm's streak of between 10 to 18% sales growth to 6 straight years, which continues to show how strong its cloud computing business is in that subscription recurring revenue, how important it will be for Microsoft going forward. Meanwhile, its adjusted earnings are projected to climb 15% this year and then another 11% next year. The company's positive earnings revision since that Q1 release last week helps it land a Zacks rank number 2 buy at the moment. So we've seen its current year consensus estimate climb 6% since its last release, and its FY 2023 estimate climb about 5%. And this is part of just a continued positive revisions trend for the stock over this past year, and if stretching back last several years, its estimates just continue to climb and climb and climb. So the company's expansion, as we mentioned, into that cloud computing space alongside Amazon and others has changed its growth trajectory as the space just continues to grow within the business world, and really everything's running on that cloud. And Microsoft is also increasingly invaluable to its customers and everyday consumers, giant enterprises, everyone in between, and it's prepared to thrive in that hybrid work environment as it competes against Zoom and others. Plus, the company finished last quarter, so this most recent quarter, with $130 billion in cash and equivalents, and returned about $11 billion to shareholders via buybacks and dividends, up about 14% versus the year-ago quarter. So another strong reason to consider Microsoft is just going to continue to buy back shares, continue to pay a solid dividend, with that next dividend payable in early December to shareholders of record on November 18th. So if you're considering that, that's worth noting. The board of the directors also approved a new share repurchase program authorizing up to $60 billion a share. The new purchase program obviously has no expiration date and it could be terminated, but it's just a big part of the reason why Apple and a lot of these big tech names are continuing their solid runs, is they also are deploying some of that cash to return value to shareholders. Its dividend yield is sitting at about 0.8% at the moment, tops Apple, and marks a solid income for a stock that continues to soar. We should also note that the company made or continues to make acquisitions. This includes its planned $16 billion acquisition of Nuance Communications, which would be its second largest deal under their current CEO. The company's at the forefront of speech recognition and AI, and it's set to roll into its ever-growing cloud computing business for healthcare clients and beyond. The company said on its earnings call that they expect that acquisition to close by the end of Q2 or early Q3. So obviously any of its growth outlook does not include that at the moment. The company also continues to make much smaller purchases constantly. It's made nearly a dozen of those purchases so far this year. The stock has also surged to new highs following its release, and it's now just ahead of Apple in terms of market cap. Its current market cap as of Monday morning was around $2.46 trillion. The stock did pull back slightly on Monday from its recent highs, and it could face some near-term selling pressure with it above overbought RSI levels of 70 at about 74 right now, and it's up already 16% in the last month alone to outpace the tech sector. So despite the possibility of it dipping in the near term, Wall Street remains really high, with 19 of the 20 brokerage recommendations that Zacks has at strong buys, with that other recommendation at a buy. And the current Zacks consensus price target for Microsoft represents 4% upside to its current levels. With that said, it is trading at high valuations compared to where it was, which makes sense as the stock continues to climb. It's trading at about 34.8 times forward 12-month earnings, which does actually mark a discount to the broader computer software market, but it's well above its median and well above its lows of 29 times forward earnings over the last year. So it is also a little bit below its highs of 36. So that's the valuation picture, but Wall Street's been willing, obviously, to pay up for Microsoft so far recently. And now we're going to move on to another company that has not yet reported its quarterly results, but it's worth considering as a longer-term tech play within this broader cloud and subscription space, and that is Salesforce, which trades on the ticker CRM. Salesforce helped start the current software as a service industry that's really every business, government, countless other entities rely on to do just about everything. Its various divisions help support sales, marketing, commerce, customer and client engagement, analytics, app development, and more. The company's grown its top line at an impressive clip since its 2004 IPO. The company's posted between 25% and 30% sales growth in the last 5 years alone. And that steady double-digit expansion highlights the strength of its business model and that constant need for companies of all shapes and sizes to adapt to the quickly changing tech-fueled business landscape. The pandemic-driven remote work world then solidified its business, and it posted record sales last year, up 24% to crack $20 billion for the first time. The company also raised its guidance, and it's really poised to thrive in this modern hybrid working world. The company then made a splash late last year when it announced its $28 billion deal to buy Slack. The company completed that purchase in July, and it's expected to help it compete in this modern work communication space, especially as more and more people are trying to have non-email based communication, especially when you're not in the office with everyone. That's going to help them compete against Zoom and Microsoft and many others in this space. And yeah, they spent $28 billion. So clearly they see this as a really important play going forward. The deal also came roughly 2 years after Salesforce paid about $15 billion for data analytics platform Tableau. So these beefed up offerings are helping it continue to stand out in a really crowded cloud software space. And its growth outlook showcases the stability, once again, of that subscription model. So this is helping all of these companies. So Zacks estimates call for CRM's FY 2022, which is actually its current year, revenue to climb 24% to $26.3 billion, with 2023 projected to jump another 21% higher to nearly $32 billion. The tech firm's adjusted 2022 earnings are projected to actually slip 10% to $4.40 per share this year. With that said, Wall Street's really looked beyond these year-over-year decline projections, and they've focused more on Salesforce improving earnings estimates, which helped it land a Zacks ranked number one strong buy at the moment. The stock has also crushed our adjusted EPS estimates by an average of 68% in the trailing 4 quarters. So these projections could continue to climb, and maybe they actually end up posting positive growth this year based on just some recent history of big, huge bottom line beats, about 70% in the trailing 4 quarters. The company shares have climbed about 300% over the last 5 years to roughly match the broader Zacks computer software industry. The stock has jumped about 90% in the last 2 years to lag just behind the space. That said, the stock is up 25% in the last 6 months to outclimb its peers, and it hit brand new highs on Monday morning as well. That said, we will have to wait a little bit longer to know more near-term outlooks for the company, considering that they don't report their results until early December, when we already have seen results from Amazon and Apple and Microsoft, who we just spoke about, and many other of the big tech companies. But as you note, Salesforce is not set to release those results until early December. The stock does still trade at really sky-high forward earnings multiples, and it does not yet pay a dividend as it focuses on its growth. But investors have been willing to pay up for CRM for a really long time and largely ignored that really high PE ratio. So despite sitting at record highs, the stock is trading a nearly 10% discount to its own year-long highs in terms of forward sales, at about 9.5 times forward sales. And it does sit 20% below its high water mark when it comes to forward earnings, even though it's still at a really high valuation overall. But compared to where it was earlier, it's trading 20% below, even though its stock is at new highs. So that's a good sign. Like with all the stocks we're going to talk about, or the first two we're going to talk about at least, the recent climb has pushed Salesforce slightly above overbought RSI levels, so 70 or higher, with it currently at about 75. This could mean it's due for a near-term pullback, but this could also be true for lots of tech names, with the NASDAQ 100 tracking QQQ ETF also approaching those overdone levels. It's sitting right below the 70 threshold. It was at 69.9 the last time I checked on Monday morning. So we could see in the next week or two, and it's obviously really hard to predict with any of these things, but it would not be shocking within the next couple of weeks or maybe before the end of the year we see another pullback, considering how far we've climbed in October alone. That said, Wall Street's really bullish on the stock, just like it was with Microsoft. 22 of the 26 brokerage recommendations that Zacks has are currently at strong buys. Nothing comes below a hold, and the overall rating has improved in the last several months. Let's also remember that Salesforce offerings aren't going out of style anytime soon, and its customers, like with many software as a service customers for business and beyond, become largely dependent on these constantly growing and adapting portfolio of business software, and therefore investors might want to consider Salesforce for its ability to expand in our digital dominated world for years to come. And the subscription model is proving successful, and it just continues to make some really game-changing purchases. And Wall Street's liked what they've done so far with the Slack deal, even though at first people were a little hesitant. But trading at new highs, and it's set to release its results in early December. And now we're going to take a look at one more of these blue chip tech names to consider buying in November and beyond, and that is Adobe, which trades under the ticker ADBE. The company created the PDF and went public all the way back in the mid-1980s. In these days, it's cloud software powerhouse with a portfolio full of some of the most important creative and design software on the market. So the firm's subscription-based offerings include Photoshop, InDesign, Premiere, many others, and as well as some newer offerings that are geared more towards that digital media age that we're living in. And its subscription model helps create stable growth, as we mentioned with all these companies, and its Creative Cloud suite. It's really invaluable to countless businesses, schools, creatives. The company has also boosted its business-focused portfolio beyond the PDF. It includes e-signature, documents, marketing unit, and more. And its diversified and relatively unique solutions provide a sturdy moat in a really crowded and sometimes redundant software as a service industry. And this shows up in its growth. So Adobe's FY20 revenue climbed 15%, and it topped our Q3 estimates back in September. So it reported September 21st with its sales and adjusted earnings both up around 22%. So looking ahead, our revenue estimates are calling for another 23% growth this year, and then another 15% higher next year, all the way to over 18 billion. This would extend its streak of around 15% or stronger top-line growth to 8 years running, which is really impressive, once again, for a company that went public in the mid-1980s. So in terms of its adjusted earnings are projected to climb 23% this year and then another 14% next year. The stock has been a really great performer on Wall Street. It's outclimbed Microsoft and Apple over the last 5 years. It's up about 500% over that stretch. That said, it has cooled off somewhat in the last year to lag behind the benchmark. Recent profit taking around earnings sent the stock back a little bit, but it did see buyers jump back in as soon as it got to more enticing levels. The stock is currently trading about 5% below its highs and somewhat near neutral RSI levels of around 57. So it could see more room to grow, considering that many of the other tech names are approaching more overdone levels. In terms of forward 12-month sales or forward 12-month earnings, it's trading about 55 times forward 12-month earnings, which is below its highs, but above its medians. So like with Microsoft and many of these other names, its valuation might be a little bit stretched, but Wall Street continues to be willing to pay for this stock, and it currently lands a Zacks rank number 2 buy at the moment. In Wall Street, it's extremely high. 18 of the 19 brokerage recommendations that we have are sitting at strong buys. The company also continues to repurchase stock, and its subscription software offerings really aren't going to go out of style anytime soon. As we mentioned, it's invaluable to countless different businesses and schools and everything like that. And as we said, it could go on an 8-year run of 15% or higher sales growth. It's really impressive. Also, its current consensus price target that Zacks has marks 8% upside to its current levels. So it's really worth considering as another longer-term tech play, like with the 3 stocks we talked about today that are part of this broader cloud space and cloud software space and subscription business software going forward. So all 3 of these stocks are certainly worth considering, even though the market could experience a pullback in the relatively near future after that big, huge October run. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.